There's been a considerable amount of discussion recently concerning the strained relations between the United States and Iran and the potential ramifications for the financial markets, particularly a surge in oil prices. This video aims to discern verifiable facts from speculation, equipping you with greater knowledge and confidence in your financial decisions. It is currently Sunday, March the 1st, in New York. I encourage you to share your location and the day you are viewing this, as I am always fascinated by the global reach of these presentations. And before we proceed, if you appreciate the research invested in these updates, please subscribe and leave a comment, David AL, to signify your participation. You may have encountered sensationalized information circulating. Here's a prime illustration of what I mean. A headline that emphatically suggests, "Divest all holdings immediately." Another report claims, "The sole prudent course of action is investment in oil and defense." Following this is a series of comments that resemble a countdown to financial catastrophe. On the surface, this appears logical, doesn't it? Discord invariably leads to instability. Instability breeds apprehension. Apprehension results in market declines. Therefore, one should divest. However, this oversimplified sequence is precisely where individuals encounter difficulties, as market dynamics do not operate in linear fashion. Furthermore, they certainly do not conform to the emotional narratives that headlines endeavor to promote. Let me elaborate. The majority of these widely circulated analyses share a common characteristic. They take a genuine occurrence, introduce a plausible risk, and then extrapolate to a conclusion that is disproportionately extreme. They commence with a factual premise: the region's significance to energy supply. Another truth: transportation routes are susceptible to interruption. A further reality: uncertainty can rapidly impact equity values. From these points, they leap to the conclusion that a wholesale divestment is imperative, and that the ultimate beneficiaries are obvious. It is precisely at this final juncture that the reasoning falters, because the entities that ultimately benefit are not always those that experience an initial surge, and those that suffer are not invariably the first to decline. Moreover, the temporal aspect is almost never as straightforward as the popularized viewpoint suggests. Consequently, our objective is to deconstruct this matter systematically and reassemble it in a manner that accurately reflects financial behavior amidst global volatility. I will caution you in advance. If your intention is to pinpoint a singular, perfect transaction that transforms fear into immediate profit, you will likely find my subsequent remarks unappealing. Conversely, if your objective is to avoid abrupt market reversals, to refrain from making emotionally driven errors, and to strategically position yourself to capitalize when the situation stabilizes, then I urge you to persist, as this is a crucial insight that many overlook. Firstly, we must address the distinction between what individuals perceive as the impetus for their actions and their actual motivations. When geopolitical conflict headlines emerge, your mind interprets this as a singular message: peril. Your innate response is to seek protection. Consequently, investors typically adopt one of three strategies. They liquidate assets and move into cash, they remain inert and paralyzed by indecision, or they pursue whatever investment has recently experienced a surge. Each of these approaches carries the potential for a misstep, contingent upon the prevailing economic conditions. Allow me to explain why. If you opt to move into cash, you gain a sense of security, but you also accept a guaranteed outcome. Your capital must contend with inflation with a significant handicap. Even when inflation moderates, it rarely abates to zero. The longer you remain on the sidelines, the more challenging it becomes to re-enter the market without incurring a premium. If you remain inactive, you are not ensuring safety. You are allowing the market to dictate your financial trajectory. The market bears no obligation to align with your comfort level. And if you chase a speculative rise, you are typically acquiring an asset at its most inflated valuation, at the very moment when public sentiment is at its most frenzied. Therefore, the pertinent question becomes, how do institutional investors approach this differently? Not due to superior intellect, nor due to possessing privileged information, but because they adhere to a disciplined process. This process is founded on a singular principle: markets initially react impulsively and then swiftly adjust. This adjustment is not always immediate or seamless, but adaptation does occur. By comprehending this adaptive phase, you will cease to perceive every alarming headline as an urgent alarm, and begin to interpret it as a weather forecast. It holds significance, but it does not imply that your dwelling is engulfed in flames. Competitor analyses often present a rigid, three-stage framework. While I find this acceptable as an educational tool, the danger lies in individuals treating a conceptual framework as a definitive guarantee. Thus, here is a more pragmatic perspective. Geopolitical shocks typically unfold in three broad phases. The initial phase is the flinch. The subsequent phase is the negotiation. And the final phase is the reallocation. These terms are significant because they compel consideration of behavior rather than mere prediction. Let us commence with the first phase, the flinch. This is the instant the headline breaks, and the market reacts as a crowd does when someone shouts, "Run!" There is no pause to ascertain the source of the alarm, nor to confirm if the exit is clear. The movement is immediate. In contemporary markets, this initial reaction is frequently amplified by automated trading systems, the execution of hedging strategies, and the unwinding of short-term speculative positions. Consequently, you will observe a recurring pattern. Assets perceived as higher risk are immediately impacted. Those with precarious valuations are affected first. Investments that were acquired because they performed favorably the preceding day are sold first. Simultaneously, there is often a surge in demand for safe haven assets. This can manifest as investments akin to cash, high-quality bonds, precious metals, the US dollar, or energy commodities. However, the critical point is that this initial market movement is not the definitive outcome. It is merely the flinch. To interpret the flinch as the complete narrative results in either selling amidst a panic or purchasing at the peak of an unwarranted surge. How long does this flinch typically persist? At times, it may last a single day, at other times, a week, and occasionally, it can be prolonged if the news cycle is incessantly updated. However, the duration is less important than what transpires subsequently. Phase 2, the negotiation, is the stage that most retail investors entirely overlook because it lacks dramatic flair. It appears mundane. The market begins to ponder, what is the genuine impact of this event? Is this a temporary disruption or a fundamental shift? Is this transient noise or the harbinger of a new economic paradigm? How will this affect energy prices? What is the consequence for inflation expectations? What does this portend for interest rate policy? How will this influence corporate profit margins? What behavioral changes might this induce in consumers? And this is where we arrive at the true transmission mechanism relevant to an escalation between the US and Iran. It is not the emotional narrative, but the energy dynamic. Not because oil possesses inherent magical properties, but because energy serves as a fundamental input. Energy is intrinsically linked to shipping, manufacturing, food production, transportation, and the cost of moving virtually every commodity. Therefore, even in the absence of direct physical disruption, the market can adjust its valuation to reflect the increased probability of higher costs. This explains why apprehension can permeate the financial system with the speed of electrical current. Now, let us exercise caution. Individuals are prone to citing precise figures as if they are immutable truths. I will refrain from doing so. However, it is beyond dispute that Iran is a significant participant in global energy markets, and a substantial portion of global maritime energy trade transits through a constricted waterway. This implies that the risk extends beyond direct damage to oil facilities. It encompasses increased shipping costs, elevated insurance premiums, extended transit routes, and consequently, a higher cost for delivering the same quantity of oil to the same consumer. The market anticipates this likelihood without delay. It prices in the risk of its occurrence. This is the reason why oil prices can fluctuate based solely on apprehension. Here is a detail that rarely features in dramatic analyses. Even when the risk is tangible, supply and demand do not remain static. Producers outside the affected region can augment their output. Governments can access strategic petroleum reserves. Refineries can modify their crude oil blends. Major consumers can hedge their future requirements. Occasionally, the most significant impact is simply an increased insurance cost and a more circuitous route, rather than an actual deficit in available barrels. This is why you frequently observe energy prices surge, then plateau, and subsequently recede as the market recognizes the world's adaptive capacity. Could an escalation devolve into a genuine supply crisis? Assuredly. However, the default presumption should be that markets first price the risk, and then they price the reality. If the actual outcome proves less severe than initially feared, a trade that appeared obvious on the first day can become disadvantageous by the 20th. One further observation. Monitor the behavior of the options market during these periods. As investors rush to acquire protection, the cost of that protection escalates, and this cost itself becomes an indicator. It is akin to hearing the roar of the crowd before witnessing the play unfold. It does not reveal the final score, but it illuminates the focal points of investor anxiety. This apprehension can fuel inflation expectations, even if official inflation figures are declining in other sectors. Based on recently published inflation data, the primary concern has not been runaway inflation, but rather persistent pockets of price increases that are resisting abatement according to schedule. Energy is one such sector capable of rapid fluctuations and influencing expectations. And expectations are crucial because they shape behavior. If individuals anticipate higher prices, they will demand higher wages. If businesses foresee increased costs, they will expedite price increases. If investors expect central banks to maintain restrictive monetary policies, they will reevaluate asset valuations. This is precisely where the second significant logical fallacy occurs in those widely circulated analyses. They presume that central banks will respond in a manner consistent with entirely different macroeconomic conditions. However, the current macroeconomic environment possesses its own inherent momentum. We have navigated a period characterized by persistently elevated inflation, and policymakers have unequivocally communicated their intention not to prematurely declare victory. Therefore, should an energy shock materialize, even if it is transient, it could render the decision to lower interest rates more challenging, not easier. This does not automatically imply an increase in rates. It signifies sustained uncertainty. And when uncertainty persists, the market demands a higher cost for capital. In essence, this is another way of stating that risk is repriced. Now, I wish to pause and challenge one of the most alluring assertions frequently repeated in analyses of geopolitical conflict: the claim that markets invariably rebound swiftly, thus alleviating concerns. This assertion is comforting, but it is also incomplete. Markets have indeed recovered following geopolitical shocks, but they recover within the prevailing economic context. If the economy is robust, if credit conditions are stable, if consumer spending remains strong, and if companies continue to generate profits, the recovery can be rapid. However, if the economy is already decelerating, if credit is restricted, and if profit margins are already under pressure, a shock can be the catalyst that transforms a slowdown into a more severe downturn. Consequently, the pertinent question is not whether the market recovers, but rather what other factors are simultaneously at play. This is why your strategy cannot be predicated on a slogan. It must be based on a comprehensive checklist. Therefore, here is the checklist I recommend you keep in mind as we transition from Phase 2 to Phase 3. 1. Is this energy price movement a temporary spike or a sustained trend? 2. Are inflation expectations rising, or is it merely a manifestation of headline fear? 3. Are credit spreads widening, indicating increased nervousness among lenders? 4. Is the currency market signaling a risk-off sentiment, or is it exhibiting stability? 5. Are companies issuing downward guidance, or are they maintaining their projections? You do not require an economics degree to monitor these indicators. You simply need to shift your focus from a singular headline to the underlying mechanisms. Phase 3 is the determinant of who profits and who merely endures. Phase 3 is the reallocation of capital. This is when the market ceases its initial reaction, moves beyond negotiation, and actively deploys capital. And it does not deploy capital in the manner that the general public anticipates. In the first phase, everyone gravitates towards the most apparent opportunities. In the third phase, the ultimate beneficiaries are often those who experience secondary advantages. The less glamorous businesses, the service providers, the entities that do not require perfect market conditions. They merely need the world to continue functioning. Therefore, instead of advising to buy oil, A more insightful question is, who benefits from elevated energy prices without necessitating continuous oil price escalation? Instead of suggesting to buy defense stocks, a more discerning inquiry is, who benefits from multi-year procurement cycles without being priced as a speculative gamble today? Instead of recommending to sell all risky assets, a more prudent question is, which components of your portfolio are susceptible to prolonged higher interest rates, and which possess the genuine capacity to pass on increased costs? This is where we will transition to practical application. However, before we do, I want to address one further common misconception. Many believe that investing during periods of conflict is about predicting battlefield outcomes. This is inaccurate. It is about forecasting the financial repercussions, where the costs will manifest, who will bear them, and who will receive payment. The market functions as a discounting mechanism, perpetually assessing who will be adversely affected, who will benefit, and for what duration. By conceptualizing these dynamics in terms of financial obligations rather than sensational headlines, you gain a significant advantage. Let us then examine these financial obligations. Obligation number 1, energy. If energy prices increase and remain elevated, the most evident beneficiaries are energy producers. However, less apparent beneficiaries include companies involved in the transportation, storage, insurance, and servicing of the entire energy infrastructure. Consider them the backstage crew at a concert. Their role is indispensable to the performance, though they are not the focal point of the audience's attention. I am not advocating for immediate purchases, but rather for understanding the landscape of opportunity. I also wish to highlight the associated risks. If energy prices surge and subsequently decline, highly leveraged, pure-play investments can experience sharp reversals. Consequently, a more prudent approach for most individuals is not to chase speculative peaks, but to select investments that can withstand multiple scenarios. This implies businesses with stable cash flow, balance sheets capable of managing higher borrowing costs, and companies possessing pricing power. Pricing power is a genuine attribute, not merely a buzzword. It signifies a company's ability to raise prices in response to increased costs without losing customers. This is the distinction between a business that is squeezed and one that maintains its stability. Now, obligation number 2, interest rates. If the market perceives a reduced likelihood or a delayed timeline for interest rate cuts, the initial consequence is a repricing of assets predicated on the availability of inexpensive capital. This includes speculative ventures requiring ideal conditions, companies reliant on continuous refinancing, and market segments where profits are projected for the future rather than realized presently. If you have witnessed the impact of higher interest rate narratives on high-growth stocks, you will understand this concept precisely. Therefore, during an inflation scare driven by geopolitical events, you should avoid overexposure to future earnings and instead seek exposure to current profitability. This does not necessitate abandoning growth entirely, but rather achieving a balance. The operative word here is tilt, not flip. Tilt. Obligation number 3, defense and security. This is the area where many individuals believe they have identified an easy profit. They encounter headlines concerning weaponry, aerial drones, and military contracts, and consequently assume a straightforward upward trajectory for defense companies. However, the complexity lies in the fact that defense projects are typically long-term endeavors. Budgets undergo deliberation, orders are placed, production backlogs are addressed, and payments are dispersed over extended periods. Thus, the market may anticipate this narrative long before the revenue materializes, meaning you could still incur losses by acquiring a sound long-term investment at an inopportune short-term price. This underscores the importance of planning over impulsive action. Furthermore, there is another aspect that is insufficiently discussed. Modern conflict encompasses more than just hardware. It involves supply chains, semiconductor technology, electronic systems, secure communication networks, cybersecurity measures, and satellite infrastructure. Therefore, when considering the long-term trajectory of security spending, do not solely focus on the prominent, heavy equipment companies. Investigate potential bottlenecks, scarce inputs, and essential services. This leads to a broader, pertinent observation. Based on recently published global spending estimates, defense budgets have been increasing across numerous regions for years, not solely in one particular country. This indicates that a shift towards increased security is not a short-term trading opportunity. It has been a developing trend, suggesting that a significant portion may already be reflected in current valuations. Consequently, the advantage lies in selectivity and patience, rather than chasing fleeting trends. Obligation number 4, commodities and hard assets. When individuals become apprehensive about inflation and the erosion of currency purchasing power, they frequently seek tangible assets. Gold is the quintessential example. However, even in this domain, caution is warranted. Gold can experience a surge based on fear, only to decline as that fear subsides. Alternatively, gold may exhibit a gradual upward trend if real yields decrease, or it may remain stagnant if the US dollar strengthens and interest rates rise. Therefore, do not treat gold as a guaranteed gain. Consider it a tool, a hedge, a stabilizing element, something that can provide peace of mind while you maintain your core investment strategy. Now, let us synthesize these points. Most individuals desire a definitive answer, such as, what should I acquire? However, the more crucial question is, what should I cease doing? This is because the most significant damage during these periods stems from poor decision-making, not from missing a single profitable trade. Therefore, here are 3 actions to discontinue the moment your newsfeed begins to inundate you with alarming information. Cease excessive consumption of negative news. Refrain from altering your investment plan with every refreshed headline. And abandon the attempt to transform a geopolitical crisis into a gambling venture. By adhering to these principles alone, you will surpass the majority of investors. Now, let us translate this into a practical strategy. Step 1. Safeguard your core portfolio. If you hold investments in high-quality businesses with substantial cash flow, the ability to increase prices, and a balance sheet capable of accommodating higher borrowing costs, you are not compelled to divest them simply because a headline is unsettling. The necessary action is to understand their specific vulnerabilities. Are they sensitive to energy price fluctuations? Are they exposed to credit market volatility? Do they rely on discretionary consumer spending? Are they globally integrated and susceptible to shipping disruptions? This requires diligent analysis, not panic-driven liquidation. Step 2. Identify your personal vulnerabilities. If your portfolio is heavily weighted towards interest rate-sensitive assets, and this situation causes you undue stress, consider reducing your exposure. This is not due to an impending global catastrophe, but because your risk tolerance may not align with your temperament. Here, I must state something that is factually accurate but often unpopular. Your investment portfolio should be structured to withstand periods of discomfort. If you are unable to tolerate periods of unease, your portfolio is excessively aggressive for your disposition. This is not a moral failing, but a matter of practical financial management. Step 3. Cultivate flexibility. This involves strategically incorporating modest, measured exposure to areas that tend to benefit if energy prices and inflation remain elevated, not a full commitment. Consequently, if energy risk premiums increase, you possess some representation. If defense spending accelerates, you have a degree of exposure. If inflation expectations fluctuate, you have some participation. And if none of these scenarios fully materialize, you continue to own businesses capable of performing well in a stable economic environment. This constitutes the essence of a resilient investment strategy. I am aware that some individuals may be contemplating, but how will I discern when Phase 1 concludes and Phase 3 commences? This is an excellent question, but it frames the issue incorrectly. You do not need to precisely time the nadir of market fear. Your objective is to avoid making imprudent decisions at the peak of that fear. Therefore, instead of attempting to identify the perfect buying opportunity amidst a downturn, focus on signs that the market is transitioning from an emotional response to a data-driven assessment. Here are a few indicators. Headlines cease their hourly escalation. Energy prices stabilize, moving away from erratic fluctuations. Market volatility subsides from its daily peaks. Credit markets loosen, and sector leadership begins to rotate in a more orderly fashion. This is when the third phase commences, not necessarily because the conflict has ended, but because the market has shifted from speculation to objective pricing. This is the juncture where you can undertake an action that may feel almost counterintuitive. You can invest when the environment still feels challenging, but the underlying financial metrics are improving. Allow me to introduce an alternative, cautious perspective, because my aim is to equip you, not just to captivate you. There exists a potential outcome where this situation doesn't resolve favorably. If the cost of energy escalates and persists at a high level for an extended duration, it can function as a burden on consumers. This can dampen economic activity. It can reduce profitability for businesses. It can necessitate sustained restrictive economic policies. And when this coincides with other pressures, such as inflated asset values or strained credit markets, the resulting downturn could be more severe than anticipated. Therefore, disregard anyone who assures you that everything will invariably be all right. It is not always all right. Typically, it is manageable. However, remaining manageable still demands a disciplined approach. And discipline entails not staking your future on a single narrative. You must spread your investments. You must properly size your stakes. You must retain liquidity for opportune moments without converting your entire portfolio into cash. And you must not employ borrowed funds to pursue fleeting news. Now I have a question for you, and I request your response in the comments. Which prospect causes you greater concern at this moment? Elevated energy prices or increased interest rates? Because your answer reveals your actual investment posture, even if you haven't consciously acknowledged it. All right, let us now examine the psychological pitfall that ensnares nearly everyone. When the initial shockwave arrives, people crave certainty. They desire someone to declare, "This is the peak, this is the bottom, do this, do that." But certainty comes at a premium in financial markets. If you delay until everything is clear, you will incur a higher cost. Conversely, if you act prematurely without a well-defined strategy, you will face a different kind of penalty. Consequently, the objective is not certainty. The objective is a consistent, repeatable methodology. This is what institutional investors possess, not because they are exceptionally intelligent, but because they cannot afford to be swayed by emotion. And you can cultivate the same resilience. Here is a straightforward way to conceptualize this. Envision your investment portfolio as a vessel. Headlines concerning conflict represent storms. All right, let us summarize with a clear takeaway. The market's initial reaction is an instinctive jolt. Do not trade based on that initial jolt. The market's subsequent reaction is a period of adjustment and price discovery. Observe the underlying mechanisms. The market's final reaction is a shift in asset allocation. This is where patient capital is rewarded. And the most significant advantage you can possess in a situation like this is not a hot stock tip. It is the capacity to maintain composure while others are overcome by emotion. Therefore, preserve your core investments, assess your vulnerabilities, strategically enhance your resilience, maintain diversification, and do not allow headlines to transform you into someone you do not recognize. And yes, I will continue to provide updates here. If you desire more videos of this nature, concise, practical, and grounded in research, please subscribe. And one final reminder before you depart. All that we have discussed today is for educational and general informational purposes only. I am not your financial advisor. I am unaware of your individual circumstances, and nothing presented here constitutes a recommendation to buy or sell any security. Conduct your own due diligence.